Waiting here. Hello, Sam. I see you there. I'm looking for Ashley. I think she's having a little difficulty getting in. So give it just a minute here and see if she pops in. Sam, if you have a way to send her that link, I've sent her the link through Messenger. She said she was in, but I have a feeling she might be in the old one. Not sure. So anyway, we'll wait just another minute. I see Sam. It's two of us here. So let's see. I'd like to welcome Diane Barcelona. Welcome on. I was looking to get Ashley in here. Ashley is our realtor who is co-presenting with me. I think she's having a little difficulty getting in to the webinar. So I'm going to go ahead and get started because I know your time is valuable and you guys don't want to sit around waiting. So let me go ahead and get started. Welcome to this webinar. My name is Bruce Cline. I'm with Oz Lending and BruceClineMortgage.com. In this webinar, I'm going to quickly go through how to go about buying your first home, how to get a mortgage, and want to help you understand the home buying process. Now, if I go too quick and you miss something, I will be sharing this through my YouTube channel and probably rebroadcasting here. So you'll be able to pause and stop and rewind, take some notes if you want. So with that being said, I'll go ahead and get started and dive right in. Remember, you can reach me at BruceClineMortgage.com. You can reach Ashley right here at DFWFriscoHomes.com. And either one of us will be happy to talk with you, tell you how we can get you. Here she is. Hey, there she is. Let me get her on here.
About the technical difficulty. Thanks so much. How's everybody?
What happens, a couple of weeks ago, mine froze and I was gone for a few minutes. So hopefully that's not going to happen today. So we've got a couple on here and I told them I know their time's valuable. So we'll go ahead and get started. And like I said, you can see Ashley is at DFWFriscoHomes.com. I'm at BruceClineMortgage.com. If we miss anything here, you have any questions, we're happy to grab a quick appointment with you. If you're not local, we could do it over Zoom or over the phone. If you want to meet for coffee, we're happy to do that if you're here locally. So wherever you're watching this from and wherever you're coming in on this, thank you for being here. Our goal is to get through this in 30 minutes and then provide a few minutes for you guys to ask questions. And I do have this I'd like to send to you guys once this is over. So this is just basically a recap of what we're going to go over here and bullet points. So we can send this to you. Just reach out to us, in an email, let us know, and we'll get some material over to you. So with that being said, let's go ahead and get started. And we're going to get started with our first slide, talking about buying your first home. And the goals in this course are going to be, you're going to learn the advantages of owning a home. We're going to explore different loan programs. We're going to discuss the cost of being a homeowner, understand how credit scores affect your loan options. We're going to show you how to complete the pre-approval process. And then, like I said, we'll take some time there at the end to answer any questions you may have. So why buy instead of rent? A lot of people ask that question, and there are some great advantages to owning versus renting. First of all, I'm sure owning a home is a wise investment. If you know anything about home values lately, you'll see that they're going up. If you purchased a home a couple of years ago, you'd be very happy today with where you're at. And I think we're going to keep seeing that. So the sooner you can get in, the sooner you start building wealth for you and your family. And like I said, home tends to increase in value, and you can build ownership and interest over time. You build equity, and equity is basically if you think of your home as a bank, equity is that money you have in your bank. As that value increases and you're paying down your mortgage payment, that is your bank. That's your equity you have. And that money you can use later, pull that out to buy a new home, buy an investment property, take it out to remodel. Lots of things you can do with that money over time. And the interest you pay on your mortgage is typically tax deductible. You want to speak to your CPA about that, but the interest you pay is deductible on your taxes. So also you get to personalize this. When you get your own home, an apartment, you can personalize it a bit, but I mean, you get to do all sorts of improvements. You get to make it your own. And if your family's growing, you're planning on having children here in the future, you want to make room for your growing family, and a starter home, this first time home buyer, this first home you're going to buy, it's a great way to start building your personal wealth. How do you begin? Now listen, just like it says here, it's easiest 1, 2, 3. First, you're going to find your home team of experts. We are your experts. That's why we're here. That's why Ashley and I are here. We want to educate you on how to become a homeowner and buy your first home and what that is all about. So Ashley's an experienced real estate agent. If you're watching somewhere outside of Texas, you just want to make sure your team is someone that's familiar with the area. So they know comps, comparables in your area. They're going to help advise you on how much you need to offer that home if you want to have your offer accepted. The next thing you do is you're going to complete the mortgage pre-approval. This is where you talk to me, a loan officer, or a local loan officer, and we're going to collect all the necessary documents, and we're going to go over the loan options that are available to you. And then, again, you're going to consult with your real estate agent, with Ashley. We're going to find out, she's going to find out what's available in the area you're looking at. Where is it you want to live? And how soon can you start looking? So now let's go through the home buying 101. It's the basics. These are just the basics, how to get started with your journey to becoming a home owner. So here are the factors of a pre-approval. All right. A lender is going to look at your credit history. You're going to look at your employment status. Are you employed? Are you self-employed? Are you a W-2 employee, a contract employee? We're going to look at your qualifying income. Is it W-2? Is it 1099? We're going to look at your existing debts, and we're going to look to see what you have for your down payment. Now, if you look here, we're going to talk about the importance of your credit history. The top line there, the green line, this shows you that about 20% of what the creditors are looking at has to do with new credit or the types of credit you have. And then about 15% is the length of the credit history. All right. And then 30% is amounts owed. And then 35% is your payment history. So if you look at the amounts owed and your payment history, it makes up a large portion of your credit history. This is why it's important to pay on time, okay, and not get yourself too far extended. We'll talk a little bit more about that. Your credit score, the credit bureaus really like that debt ratio to be around 30%. So if you've got it around 30%, that's going to give you the best score. If you're up around 80, 90%, you need to find a way to get that down closer to 30% to improve your debt ratio, which will also improve your credit score. So, and this will tell you a little bit about the importance of your credit history. So what we're talking about, on-time payments, a history of monthly payments on time shows that you're more likely to make your mortgage payments on time, right? So that's what they're looking at. If you've got a lot of late pays in there, and we see this often, late payments are one of the quickest ways to lower your credit score. And guess what? There's nothing you can do about late payments. They are on there, and from my understanding, they're on there for 7 years. So make your payments on time. If something's happening, you can't, try to reach out to them and get some sort of arrangement. So they show 30 days late, 60 days late, 90 days late, and those stack up and really reduce your credit score. It can be a factor in the type of mortgage you qualify for. So we haven't talked about the different loan types yet. We'll talk about conventional and FHA. And sometimes if your score is lower, you're not going to be able to qualify for one of the premium loans that you want to get. Maybe the conventional loan is best for you, and you're not going to qualify with that score. Or if you do qualify with a lower score, you're going to pay a lot more for the rate you want, and you're going to pay more in what's known as your mortgage insurance, which if you put less than 20% down on the home, you'll pay mortgage insurance, which if your credit score is lower, your insurance is going higher. So I can't stress enough to keep that credit score in check. It can also determine the amount that you can be approved for, how much you can borrow. And again, as I mentioned, that interest rate is greatly affected by your credit score. Big question here. We get this a lot. How much do you need for a down payment? Well, here's a good point. You don't need 20%. Okay. You like to hear that? You don't need 20%. A lot of first-time home buyers are under the impression that they need 20%. Well, if you're buying a $300,000, $400,000 home, that's a lot of money. And a lot of us don't have that much saved up. And perhaps you've just been through a divorce. You're a single mom, a single father. You don't have all that money saved. Well, that's why there's all these different loan programs. So that there's flexible mortgage programs with down payments of less. So conventional 3%, for example. FHA is 3.5%. So you can also, if you see that second point, buy a home with very low, that 3%, 3.5%, or no down payment. And we'll talk about those here shortly. Be prepared for closing costs. And a lot of people don't include all that. You think, oh, it's 3%, the home's 300,000. You do the math, but you forget you're going to have closing costs that can be anywhere from 3 to 4%, depending on the county where you're purchasing. And you have attorney fees and recording fees, your appraisal, inspections. There's a lot of things that add up to the cost other than just your down payment. So you want to be clear with your loan officers exactly how much you would like to put down, and then we can review your estimated out-of-pocket costs, and we can send you a spreadsheet that shows you all of those particular loan costs. How we doing, Ashley?
I'm agreeing with what you're saying. You're doing great.
All right, making sure we're staying on time. She's a timekeeper over here too. So slap me on the hand. Come on, Bruce, hurry it up. All right, so moving on. How much can you afford? This is what everyone wants to know now, and it has to do with your debt ratio, right? So listen, we see it all the time, and Ashley can attest to this. People are out looking for homes on the weekend. They see a home, they fall in love with it. That is my dream home. I want this home. But they haven't been pre-approved yet. They've not been pre-qualified. And so then they call us. We hurry, we run the numbers. Well, guess what? That home is out of your reach. You've got this debt, this debt, this debt. It's not affordable. So we are going to look at your credit history, and we're going to assess your debt to income ratio to determine the amount of home for which you will qualify. Now, the debt to income ratio is typically, it's the anticipated total housing payment. Okay, so that includes the principal, that's the loan amount, and then how much you're paying for homeowners insurance and property taxes. Okay, that gets included, and then any other debt payments, a car payment, student loan payments, credit card, the minimum payments that are required. All of those total up to your monthly debt, and then you take your gross monthly, that's before taxes and insurance are taken out, and you divide that. Okay, so you're taking your debt and you divide it by your gross monthly income. That gives you the ratio. Ideally, 45% is where Fannie Mae, Freddie Mac, they love that number, 45% or lower. You can go higher if you're looking at a VA or an FHA loan, which we'll talk more about that later, but you can go higher up to 55%, and I've seen it even higher It really depends on your credit score, your credit history, your on-time payments. All that plays a role in what ratio they're willing to accept. And there's other different qualifying guidelines for expanded, like I just mentioned. If you've got a higher debt to income ratio, that it may be available to you, but all those other factors, your credit score, your payment history, all that plays a role in it. So what is included in your mortgage payment? This is something called pity. I pity the fool, right? So it's pity, P-I-T-I. What does it stand for? Well, you can see it stands for principal, interest, taxes, and insurance. So your principal is your basic loan amount, and that's what you're paying towards that loan amount. The interest is the percentage of interest you're paying for the pleasure of having that loan, right? And then you've got your taxes. So your property taxes, depending on where you're buying, that could be 2%, 2.3%. And Ashley and I can show you that when you find an area or a home you're interested in. And then your homeowner's insurance, which covers any, fire, catastrophe, things like that you'll have. All of that together combines for what's called your PITI, and that makes up your monthly mortgage payment. So it's important to know when you're looking at a home, don't just do the math and go, well, that house there's 300,000. I'll put down 20% or I'll put down 5%. And then you do the math and figure, oh, my payment's only going to be, $1,400. Well, no. Did you factor in your homeowner's insurance? Did you factor in the property taxes? And then all of a sudden you have sticker shock because the property taxes could be $400, $500, $600 a month. And all of a sudden your payment you thought was around $1,400 is $2,100, right? So it's important that you go over that with one of us so we can coach you through that. All right. Now let's talk about the process. So, and the home buying 101, which loan type? There are several different loan types that we'll talk about, but primarily here we're going to talk about the conventional and FHA. So conventional versus unconventional or non-conventional loans you'll hear. Let's talk about the difference so we can understand the difference. Basically, conventional loans, and these are probably the most desirable loans. If you're a seller, you want to see people come in with an approved conventional loan in most cases. That's not always true. It depends on where the home is. There are many factors involved. Conventional loans, basically in a nutshell, they're not insured by the government. All right. So they're not the FHA or the VA, the USDA. They are not government insured. They are Fannie Mae, Freddie Mac mortgage loan products. Conventional loans they're like I said, backed by Fannie Mae and Freddie Mac. They will only accept a lower debt to income ratio threshold. When I was talking about 45%, typically on a conventional loan, if you go over that 45% threshold, we're going to start talking about you need FHA, or we're going to have to get rid of some of your debt, or we're going to have to lower your purchase price. Higher credit scores of 680 and above are preferred. Now, we'll tell you, if you're at 680, you can get a little bit lower and still get conventional, but the cost for the rate is going to be higher, or you're going to pay more for that rate. And you'll hear lenders talk about points fees. You want to buy that rate down with points. We're seeing right now, a lot of times that what the par rate where there's not points, a lot of times there's still a fee there involved, especially if your scores are lower. So you really want that to be in the 700s, preferably over 740. But don't let the credit score prevent you from pre-qualifying, because we can often find a way to get your score improved while you're shopping for a home. And I'm happy to answer your questions about that. So type of conventional loans include conforming. This number is wrong. I need to change the slide. It used to be 510, 400. Now it's 740, 200. So if any of you guys are wanting to buy a $740,000 first time home, you can do that on a conventional loan. I don't know if maybe you won the lottery and that's what you want to do. And high cost areas can go a little bit higher. And those are like New York and California and some higher cost areas in the United States. Now the non-conforming, those are jumbo loans. And that number's wrong too. It's now at 970,000 roughly. And the types you can get a fixed rate, and we also have the adjustable rate. You will hear, now most people do the fixed rate, especially over the past years. Now that rates are moving up, we're starting to see more people look at adjustable rate mortgages. That should not be a scary term. I'm happy to explain it to you. It's really a great product for a first-time home buyer, because first-time home buyers typically get into a new home and you're only there for 5 or 6 years because you're moving upward, right? So if you have an adjustable rate and you lock that lower rate in, because it comes with a lower rate for the first 5, 7, or 10 years, you can get in with a lower rate and a lower payment. And then before it adjusts, and it might go up a half point or whatever, but before it makes that adjustment, you're already ready to move on to the next home. So you were paying a lower rate on that ARM, adjustable rate mortgage, which it's a good product. And I'm happy to talk to you about that, especially for first-time home buyers, because you're not going to be there long. So now let's talk about the non-conventional loans, right? These are the ones that are insured by the government. These loans are going to be your FHA, the Federal Housing Administration, the USDA, and we have state bond programs as well. I will tell you on the U.S. Department of Agriculture loans, those are zero down loans and they're in more of rural areas. The threshold, the debt ratios, they're very stringent on that. So while we'll look at that, I just want you to know that up front. We'll try to get you into that if at all possible, because it's a great program. It's zero down, but it's a little more difficult to qualify for those loans. And the state bond programs, we've got Texas State Affordable Housing Corporation, TDHCA, SEF. There's 3 or 4 different programs that I have that I can offer you that will give you anywhere from 2 to 5% in down payment assistance. These are great. You don't necessarily have to be a first-time homeowner. There are certain criteria. You've got to have a minimum 620 score for most of these. There's also a loan limit you can't go over, and it's all based on the county. So this is something we'll look at when we're talking about loan options. We will look at that with you and see if you qualify, because, hey, even if you have enough, if you have 3 or 5% down or even 20% down, but you qualify for one of these, if they're going to give you 3% towards your down payment and closing costs, leave that money in the bank. Use that money for maybe furniture as you're, buying for your new home. So it's still a good option to look at. And the rates are a little bit higher depending on how much you're going to be taking in down payment assistance. The VA loan, of course, VA Veterans Administration. So that's for military members. You can be current or retired, or you can be a veteran. And those loans have no down payment, no PMI. That stands for private mortgage insurance. And if you're doing a conventional loan, if you don't put down 20%, you have a private mortgage insurance premium until you get to that 20% threshold. And there's a funding fee. If the veteran has 10% or more disability, the funding fee is waived. Okay, so that's how you become eligible for the funding fee to be waived. Otherwise, it's 3.6%, but you don't have to come out of pocket for it. That money can get rolled into your loan amount, but it does count towards your ratio. All right, I hope this is all making sense, but do remember, it will be on our YouTube channel where you can go back and slow it down and rewind. So let's talk about which type of loan is right. What is right for you? And this is what's so important, to have a conversation with Ashley or with myself to talk about the different options available to you, because we want to see which one is right for your current situation, what's right for your family. How long do you plan to stay in this home? Will this home become an investment property for you in the future as you move into a new home? So there's lots of things to talk about. There's, like I said, there's a range of finance and down payment options. Interest rate, everybody talks about interest rate, but it's only one component to getting the ideal mortgage. So for example, if you want down payment assistance so you can leave several $1,000s in the bank as your nest egg or fall back on, or your emergency fund, and the rate's 0.5% higher, listen, I promise you, if depending on your loan amount, if the rate's a little bit higher, your payment's not going to be a whole lot higher. And when you go to bed at night, you don't even know. I guarantee most people I've talked to, if you've had that rate for a few years, I ask people all the time, what's your rate? I don't know. So you don't go to bed thinking about your rate. You go to bed thinking about, how much money do I have? Am I going to be able to pay my bills at the end of the month? Is my mortgage payment, am I comfortable with my mortgage payment? And oh, I have an emergency fund in the bank. That's why it's important to talk about all these aspects so you're not extending yourself. So that's what it says here. Work with an experienced mortgage professional so you can get the one that best fits your needs and your family's budget. All right, good stuff. I hope you're enjoying it. I hope you were taking notes and maybe soaking some of this in, but again, we'll be available for questions. Now, this is, let's talk about the home buying process. Basically, there's 6 steps to the home buying process. Step 1, first thing you're going to do is you're going to complete the loan application. A very simple app for that. I can send it to your cell phone. You can do it on your computer if you like, but you complete that app. The application, you're going to provide me with income and asset documentation. So your bank statements, pay stubs, W-2s, things like that. I'm going to look at and verify your income to see how much you're getting. And then we're going to get a pre-approval letter based on everything you've sent me. I'm going to look at your credit. I'm going to look at your income, look at your assets to make sure you've got the down payment that we talked about. And then we're going to get your pre-approval letter based on that. And I'm going to send that to you and to your realtor. I'll send it to Ashley and say, hey, I've got them pre-approved up to this amount. Now, step 2, you're going to review that with your realtor, review that with Ashley, and discuss your purchase options. And then you're going to formulate a plan to see the homes that fit your budget and your needs. And Ashley will send you a great list of properties that you've already discussed. And you can look at that before you even go out and start viewing homes and pick the ones you want to look at. So then that's step 3. You start shopping for homes. You want to stay focused. Be talking with Ashley about this. Don't get discouraged. Just stay at it and stay focused. Stay within your budget, and then keep in touch with us. So, and you don't want to make do any large spending. Don't apply for new credit. Don't get a new job. Don't do those things while you're completing this process. All right. So now step 4, you have found your home. Great. You found the home. Congratulations. Now what do you do? Well, you're going to work with Ashley and you're going to talk with her about the offer. All right. So this is very important in the market, especially right now. Ashley is going to know, she's going to research that neighborhood. If she already doesn't know that neighborhood, she's going to see the most recent sales that were made in that neighborhood and send you a list of comparables if you need the comps, or she's just going to have the comps. And based on that information that she's gathering that she already knows, she's going to make a recommendation to you on how much you need to offer for that home. Okay. So it could be this asking price, but you need to offer this much. And she's going to be the expert to guide you through that. If you want your offer accepted, you're going to want to listen to that and be prepared to pull the trigger when that time's ready. So then you submit your offer with your earnest money deposit, and that's typically 1%. That would be in your contract, and you submit that, and that goes into an escrow account. And then at that point, step 5, you're going to be ordering the appraisal and a property inspection. You order the appraisal through the lender. You put that on a credit card. It is something you pay for up front, one of the few things you pay for up front, and probably your property inspection. And if you need a survey, but there's usually, depending on the home, there's usually a survey involved already. So then at that point, I'm going to collect all of your updated documentation because, see, you might have started shopping for a home 2 months ago, right? I pre-qualified you 2 months ago, and now my pay stubs, my bank statements, everything I got from you is old. Okay, we have to have the most recent 30 days of documents. So I'm going to reach out at that point and say, oh man, you ready to make the offer? That's great. Let me get updated pay stubs. Let me get your updated bank statements, and we're good to go. And then once I have all that, it goes into processing, and the processor reviews it, sends it to the underwriter. And then step 6, you got final loan approval. Boom, popping the champagne. We're excited. You got the approval. We're good to go. I will send you your closing disclosure. Okay. Once you sign that closing disclosure, you can close within 3 days of that. That closing disclosure is going to have all the pertinent information on it, the fees, everything that we've talked about all through the loan. And you're going to review that, make sure everything's accurate, sign that electronically, and then you will attend closing. The title company, your realtor, they'll schedule your closing time. You will sign the final documents and get the keys to your new home. So pretty simple, right? So let's quickly recap. We are at the 30-minute mark, Ashley.
You're doing great. Way to go.
All
Right
right.
on time.
Right on. So we'll recap here. We talked about why owning is better than renting. And I don't know that I really need to explain that to you. Just quit paying other people's mortgage, okay? So you're just making other people wealthy. So don't make your landlord wealthy. Start building wealth for yourself. We talked about the pre-approval process. We talked about your credit report and how the scores affect your loan and your loan approval. We talked about the down payment options and down payment assistance. We talked about closing costs, and remember to factor those in on top of the amount you're bringing for down payment. We talked about different loan programs, conventional, unconventional, VA, FHA, USDA. Of course, we just touched on those. We're happy to go into more depth on those as you have questions. And then we talked about the mortgage payment details. Remember, PITI, principal, interest, taxes, and insurance. And we reviewed the 6 steps of the home buying process. Now, I don't know if we have anyone on here. If you want to type in a question, if you have a question, we are happy to answer that right now. But if not, look here. You can go right to either of our websites. You can see our email is here. Bruce.Cline@OzLending. You've got Ashley, by the way, no E in Ashley. That's not a typo. It's
That's
Ashley at dfwfriscohomes.com. And you see our websites here, BruceClineMortgage.com and dfwfriscohomes.com. We'd love to schedule a consultation with you to answer your questions, meet you for coffee or happy hour, whatever you prefer.
Or
if you're
Zoom.
local. Or we can do
right?
Zoom. We can do Zoom anytime. Restream, do Zoom. We are flexible.
So Bruce, I had a question come in. I thought that we would address
Yeah,
it. Someone just
absolutely.
asked, how important is it to have a pre-approval letter? And I actually have a true story that happened this week. The people that I'm working with are super excited. They let me know about a month ago that they were wanting to purchase. So I've put them in the front, in the process of working with Bruce and getting everything going, and they have failed to actually get him everything that he needed for them to get pre-approved. They found a house they loved. They absolutely loved it. And they had me running around and typing an offer up and submitting an offer, but because they didn't do it the way that we had requested them to do it, there's a certain process of how to do these things. We submitted an offer, but Bruce did our information on his back end. So we were actually out of time. And that just goes to show how this is a teamwork deal. It's not one of those things that you can just wake up on Saturday morning and go, hey, babe, let's go buy a house. It's not that easy. There's a lot of due diligence that's involved on behind the scenes with, making sure that that you can get it all going, and we're all working towards the process. So it's so important to make sure that you get that pre-approval letter, because you're going to find a house that you love, and if you don't do it all the right way, then we just we can't play, really. We just can't play.
Absolutely.
So
And
they're they know now, they've got to get all this information into Bruce. And I think I've got a pre-approval letter coming from you in a day, I think. So hopefully we can get them back out there and not lose any momentum, and stay high spirited, right?
Yes. Yes. And it's so important. I mean, because you're going to see something and fall in love with it, and you're going to call me and go, hey, I need that pre-approval. I'm going to go, remember the W-2s I told you that I needed? I've got to have those. Remember those pay stubs? Your bank statements I asked you for, I've got to have those. I can't just send a pre-approval letter, because if I do, we're putting us all at risk. You go make an offer on this home, and then all of a sudden 2 weeks in, I'm like, oh, guess what? They don't qualify for this home. everyone is upset, and you could lose your earnest money deposit. So if you put $5, $6, $10,000 in as a deposit, and then you don't qualify, you could lose that money. So you don't want to play with that, like she says. And it brings up another good point. People ask often, if I have a pre-approval, does that mean I'm approved? And the answer to that is no, because there are many things that can happen during the process. There's going to be a final verification of employment, a verbal one. So we get one up front, but at the end, we're going to be calling your employer, make sure that your salary hasn't changed, you haven't changed jobs. There are things that can, something hits your credit. I've had that happen. I can't tell you how many times where they are approved, they're at this score, and then a collection hits your credit while the loan is processing. Guess what? Your credit score just dropped. You no longer are approved for that loan we had you sitting in, and we've got to rework it, and it becomes difficult. And what we do up front to ensure that we have a good loan moving forward, there's something called the automated desktop underwriter. And once I gather all your information and I've crossed all my T's, dotted all my I's, I have your income in there. I've got your job history in there, your residential history. I have your pay stubs. I've verified with your employer. I have everything I need. Now I have the loan amount. I have the purchase price. I've got it all there. The ratios look great. I submit it to that automated desktop underwriting system, which comes back and says, approve eligible. Approve eligible, meaning everything looks good. We can move forward with the way you have this loan structured. So during that, 15, 21, 30-day period, things could happen, things could change. So that's why we're so diligent about it. And don't take out any new debt. Don't go buy, don't change your job. But it's so important to get that up front. I can say, hey, I have it. Now, what changed? Did something change? Well, our desktop underwriter findings show us everything we need to get you through the underwriter to an approved loan. And it's going to tell us we need 2 years. If we need tax returns, it tells us we need 2 years W-2s. It tells us we need your most recent 30 days of pay stubs. So all those things that we've already asked you for, and then it may ask us for a couple more. And sometimes borrowers get frustrated because there's a lot that goes on. We're asking for a lot of documents. But remember, you're asking for maybe several $100,000. So it's important that we get what we need to make sure that you're not going to default on the loan. So that's why, and it can be aggravating because then you get towards the end and you go, why didn't you ask me for that 30 days ago? Well, it wasn't asked for up front. It came up. Or now we've gone past 30 days. Well, guess what? Now I don't have your most current bank statement. I don't have your most current pay stubs. So we have to have the most current 30 days. So that's why we try to stay engaged, answer the questions along the way. It's just very important.
So I don't see any more questions in the chat. One last, round. Anybody got anything last minute? This was a great call. I think there was a lot of good information that was thrown out there. So, I guess I'm not seeing anything in the chat. So go ahead.
If you do want this, just email one of us. I'll send this over to you. It's just kind of basically a checklist over everything we went over. You'll have that information. If you have any questions about any of these slides, we're happy to address those with you.
And
Thanks.
one more quick tip, if you happen to be driving and you don't want to type this over, or, let's concentrate on the road, just simply
Right.
take a picture with your phone, just use the little screenshot, and you can always refer back to this image tomorrow morning and get in touch with us. So we appreciate you. Bruce,
Thanks,
sorry
Ashley.
I had a little technical issues earlier.
Hey.
I don't know.
Hey. Next time it'll be me. So
well, that's the truth. Yeah, it was you, me, and you go, I go, you go, I go. Anyway,
I'm just grateful. I'm just grateful that we have the technology to present this, guys, to all you guys. So thanks again. And listen, we'll be here in a couple of weeks. Maybe you've got a friend, family member who's looking to purchase and they need to dive in and understand the process. That's what we're here for. So you guys have a great week. Thanks, Ashley.
Yeah, next Tuesday, 6 p.m. See you soon. Right. 2 weeks from now. See you soon.
Right. 2 weeks. Take care. Bye-bye.